Alright, let's see. Got the stream up and running. Welcome back to day 31. I think part 2 now. I'm just finished lunch and explored the campus a little bit. Now I'm sitting outside, I think one of the food courts here. And it's nice, so I think I'm going to spend a little bit of time here until my computer dies. And once it dies, gotta go find a library or go back to the business school and charge my laptop and my phone there. So I think for this stream, I'm probably gonna review some of the flashcards I made earlier about credit, and then also read through the book about navigating debt crises. And so let's get started with this. Okay, seven flashcards on credit. It's not too bad. Okay, loan syndicates. Yeah, so this is something that kind of scared me before, but turns out a loan syndicate is just a group of companies. Companies can be investors such as private equity firms. You have pension funds, asset managers that are all going to come together and create loans to loan out to a single institution. And so usually how this works is you have some type of bank, which is kind of this intermediary that acts as an arranger for the loans, and they'll try to raise funds in order to loan out to a company. But instead of taking on all the risk itself, the bank will create a syndicate, which is all of the different companies that I listed, and they'll actually be the providers of capital, the lenders that would help lend to the actual company itself instead of the bank, but the bank will still take on a fee. You have banks, pension funds, insurance companies that make loans to. Okay, so syndicated loans. Syndicated loans are a result of a loan syndicate. So these are loans that are syndicated by arrangers, so banks that will build a collection of companies, and each of those companies will provide capital for a corporation. And so all of the collection of all of the loans from these syndicates forms a syndicated loan. How are debt and equity instruments like tickets on an airplane in relation to a company's capitalization structure? So when we look at an airplane, we can think of the different tickets you can buy as different classes within the airplane. So when I bought my plane ticket to LA, I saw that there were first class tickets, business class tickets, economy plus, and economy. And when we think about a company's capital structure, you have senior debt, senior secured debts, bonds, preferred shares, and then common shares. And so these different classes of instruments, first debt and then equity, are really similar to the idea of different classes for planes. And this idea comes into play when we think about kind of the boarding process and exiting process of a plane. Usually it's the first class, then business class, then economy plus, then economy. And then when you board the plane, then when you get off, it's first class, business class, economy plus, and economy. And so when you think about the capital structure, it's the debt holders and then the equity holders that have ownership or that are prioritized when a company decides to liquidate its assets. So senior secured debts, senior secured loans, those are the people that are treated the best. Those are your first class tickets. They're the first in line in order to, recoup all of the debts outstanding, so the principal and any interest payments from the liquidation of a company's assets. And then you move on to your bondholders, so they're next in line. And then preferred shares, equity holders, preferred and common stock, they're both kind of in the last place. They get whatever's left over, and sometimes if a company is really leveraged, that's probably not a lot. Each of these instruments are treated differently by the company. The debt instruments are higher class compared to the equity instruments, meaning that when passengers board next to the plane. Okay, that's cool. What does the broad syndicated loan market refer to? So when someone says the broad syndicated loan market, It's just a really, really fancy way of saying that it's a bank asking other people to provide loans for a single company. And so what that looks like is a company requesting debts or capital. They'll ask a bank to find other people to invest. Okay, let's start from the beginning here. A company that wants to raise funds through the debt market will ask a bank to provide a loan for them. What the bank will do, they'll arrange a syndicated loan. What that means is they'll go to different financial institutions, ask if they want to invest, which means provide capital in order to give to the actual company itself at some specified interest rate. And then financial institutions, whether they want to participate or not, eventually, hopefully, the bank will find a collection of institutions that can provide all the capital needed. I think if not, then the bank itself will also provide a little bit of capital to compensate for the entire loan itself. So that's the broad syndicated loan market.
So we still have to make the figures for
Lend to single organizations. Private credit. Okay. Private credit is different from the syndicated loan market in the sense that instead of going through a loan arranger, a lot of companies will go directly to private institutions, meaning financial institutions that may not serve as intermediaries. And so usually these are going to be your private equity firms, maybe directly pension funds, asset managers, or insurance companies. And these people will directly lend out money or loans to the company itself. Investors that lend directly to it. Usually smaller than the size of a traditional syndicate. Okay, 6. Okay. Oh, what are debt tranches? So debt tranches are something that I was always scared to think about. It seems kind of fancy, but really all it is just separating the risk or separating debts by some type of metric, whether it's risk, maybe seniority. It's kind of cold too. So the
so chill the last month.
With debt tranches, usually it's described in a deal structure, a financing deal, or maybe a structured finance product where you'll have pools of these.
So in this outline, I've read.
You'll have pools of these debt assets, and they're organized together by their risk, their credit risk, or maybe their seniority. So credit risk, you'll have, let's say, different levels of debts. Your AAA rated, these are your pretty much default free credit, low credit risk instruments, debt instruments. And then below that you have your AA, A, I think BBB, and then anything below that will be non-investment grade. And then for, say, you're organizing your debt with tranches by seniority. And I think seniority refers to whether or not you're first in line, second in line for the repayment of your loan or shares whenever a company goes bankrupt. So I think that's a broad idea of debt tranches. Let's see. Makeup, financing, deal, capital structure. Tranches usually are split by the risk of the debt instrument, for example. Creating different tranches of debt for senior and junior debt. Tranches of debt for secured and unsecured debt. Okay. There are differences between loans originating from private credit market and syndicated loan market. So when you're looking at the private credit market, usually what you'll find is that compared to syndicated loan markets, private loans don't have any actual credit rating from rating agencies. Second is that usually these private loans aren't traded on some secondary exchange like the syndicated loan market would. And I think the third one is that private loans are usually held into maturity, so they're a long-term investment. Maybe syndicated loans, they can be traded on a secondary market exchange, or maybe it's an exchange. I'm not too sure what it is actually, but I think it could be a short-term or a long-term investment. Okay. Okay. Last thing is that private credit market loans are usually unitranche. So that means that there's a single tranche here. It's not really split into different types of credit risk or default risk tranches. So that's also interesting. Yeah, I wonder how these different assets are traded and the actual, I guess, fixed income market. I've always been confused about how all of this stuff works, and I don't really have any experience working with a trading firm on, let's say, a fixed income desk or a bond desk. To be fair, I don't have any experience at all within the investment world, but it'll be interesting to get some experience in that and see what that's like. So I'm gonna say this is okay for now. Yeah. Okay, so what's a loan syndicate? This is what we were talking about before. Loan syndicate is just a collection of financial institutions that will come together and pull together resources or capital to loan out to some sort of company that's in need of capital. Which ones? Yeah. What is a syndicated loan? Syndicated loan is just a loan that's created by a loan syndicate. So it means it's a collection of different companies, different financial institutions that pull together capital to lend out to a company, and that capital is a syndicated loan. How are debts and equity instruments like tickets on an airplane in relation to companies' capital structure? So I think this has to do with the fact that when you're on an airplane and you're looking at the tickets, there's usually different classes of tickets you can buy. There's your first class, business class, economy plus, and economy. Maybe some stuff I'm missing here, but that can be kind of similar to how capital structures work for companies. So, for example, you would have senior secured loans, bonds, preferred shares, common shares. And so they kind of have their own classes because they're treated differently by the company itself. Usually, senior secured loans, these are going to be the best treated type of debt securities. These are the people that are senior to the actual obligations, or I guess the assets within the company. That means they're going to be the ones that are paid back first in the event of bankruptcy. Their loans are also secured, so that means that there's collateral backing the loans itself. The company can post up collateral, meaning that they'll have some type of tangible asset or asset that they can sell off in the case that the company itself doesn't have enough sufficient capital to pay off the loan or pay off interest payments. Or instead of selling it, they'll actually give it to the person who is lending. Then you have bondholders. These could be your unsecured loans or maybe your junior debt, so they'll be the next in line, and they won't actually have any collateral posted up against for their debt. And then you can move on to the economy plus and economy section. So those are going to be your preferred shares and equity shares. These are all people that are kind of fighting to get the leftovers after a company has given all of their assets to the debt holders. And so whatever's left over, it's given to the equity holders, and sometimes it might not be anything at all. Nothing's guaranteed. But it'll first be preferred shareholders, I believe, and then common shareholders. Okay, let's see. Economy plus preferred shares. Each of these instruments are treated differently by the company. Exit the planning. Returns. And the channels. Okay. What does the broad syndicated loan market refer to? So the broad syndicated loan market just refers to the idea that you have some type of intermediary, most likely a bank, acting as kind of this connection between a company that's looking for capital and people that are willing to actually give the company capital. So this arranger will So companies will go through an arranger to arrange a syndicated loan by asking other investors, other financial institutions to post up capital in order to loan out to the single organization. And that's the idea of a syndicated loan market. What is private credit? So I think private credit refers to the idea of alternative sources of capital from people that are looking for debt. I guess capital raised through debt. We just talked about the syndicated loan market, and that's an option for companies that are looking for capital. But another alternative is the private credit market. So the private credit market kind of, I would say it bypasses the intermediary that's usually common in the broadly syndicated loan market. So that's going to be your banks. And instead of going through your banks, these companies will go directly to your financial institutions that are willing to lend out for some type of premium to a company for some type of, they'll lend out to a company that's looking for capital. I'll just say that. And some common institutions would be your private equity firms, pension funds, insurance companies, asset management companies.
And my cousin lives there, so
Okay. I'd say it's okay. What are debt tranches?
I have an hour and a half until I have to meet with Sarah.
I think this is the last one I'm going to do, and then I'm going to get started on the inflationary depression on the book I'm reading.
Yeah. Okay.
Navigating Debt Crises. Okay. I'm getting carried away here. But I'm thinking, so debt tranches, they're a way of organizing your debt securities, your debt instruments based on certain types of metrics. So that could be your credit rating, maybe the seniority of the debt itself. And so in the world of capital structures or financing deals, structured finance, debt can be organized in different tranches. Let's say credit rating tranches. So AAA, AA, A, triple B. You'll have tiers of these different tranches, and I think investors can invest in those different tranches themselves. Similar to the credit rating tranches, you can also maybe have senior versus junior, first lien, second lien, and these different tranches describe how the order of being paid back the actual debt owners will have or the investors will have. So I think senior debt, they're the people that are first in line, your first class tickets that will be paid first if a company goes bankrupt, and then your secondary, your junior debts or your second lien, these will be people that will be paid after. Okay, so that's good for now. I think what I'm going to do now is, maybe I could review some of these navigating big debt crises, because I still have a bit here that I have to learn. So how does Ray Dalio compare long-term debt crises with short-term debt crises? So I think the long-term debt crisis usually involves a higher inflated level of debts compared to income. So that's usually your debt to GDP. GDP is a common way to measure income within a company or an economy. And then also monetary policy for governments or policymakers aren't as effective as monetary policy in short-term debt crises. I think the most common one here is that interest rates are going to be close to zero during a long-term debt crisis. So that limits the ability for policymakers to really fluctuate or control the economy by fluctuating interest rates. Okay. Who/what primarily controls the availability of credit? So I think in most cases, in different types of economies, it's going to be the central bank that is the main contributor to the availability of credit. They're the ones that can really determine the level of interest rates. I think in the US, it's the federal funds target rate that the US Federal Reserve is able to control in order to control the interest rates that are lent out to each other by different financial institutions. Okay, what is a bubble? So a bubble, I think in Ray Dalio terms, is this idea of people are having these elevated or overly optimistic views on asset prices and growth, and that causes asset prices to explode to unsustainable levels. The combination of unrealistic expectations and reckless lending results in I'd say the combination of unrealistic lending and reckless lending. So I remember when we were talking, I think when he was talking about, so Ray Dalio, he goes into detail a little bit about these deflationary depressions and inflationary depressions. And apparently each of these have their own type of cycles, different phases, and the bubble phase is one of them. And it seems like most common, usually in these phases, there are these unrealistic expectations of growth. Asset prices are inflating and also growth is also increasing, but that in itself kind of has a self-reinforcing upward cycle that results in reckless lending. So I guess this is an okay definition. I'm going to keep it for now, and then if there's a better one along the way, then maybe I can update this flashcard. Okay, so how does Ray Dalio define the ideas of credit and debt? He defines it as credit being just the availability of buying power, and then debt is the exchange of buying power for the promise to pay it back at a later date. Yeah, I think so. So you're giving up your buying power right now, but I think the promise to pay it back. I would also add maybe for a promise to pay it back, plus a reward for giving, plus an incentive for giving up buying power now. So this is usually through interest. Exchange of buying power plus an incentive for giving up buying power now. Our economies whose growth is significantly supported by debt finance building of investments, real estate, and infrastructure, prone to large cyclical swings, why or why not? So this is something that I think was mentioned, that economies whose growth is significantly supported by debt finance buildings of fixed investments, real estate, and infrastructure, they tend to be prone to large cyclical swings, just because when an economy is over-reliant or relies heavily on these types of projects, these projects are big in the sense that once they're finished, usually the demand for these projects or similar projects is satisfied. So I think an example is if an economy is stimulated by the production of a power plant to supply energy to some of the local cities, towns, you don't really need 10, 20 different power plants to do that. Once you have a single power plant running, or maybe a small collection of power plants, then there really is no incentive to build more. And so while you might have a temporary stimulation in the economy from these large projects, once they're finished, it's difficult to continue the demand for these types of projects, and therefore all of the people that were involved in this project, so the people that are providing raw materials, the workers that are being hired to construct and consult and design, they're probably out of jobs at this point, and that limits the growth of the economy due to less production and less value being generated. So we're seeing what needs to come from other projects that may or may not exist. Okay, so I think this is similar to the idea that I had. There's a demand for housing once enough housing is developed. Okay. Okay. When looking at the economy of a nation, what are the figures that Ray Dalio suggests would show a typical bad debt situation? So when we're looking at an economy, I think Ray Dalio suggests that, let's say in a kind of typical or hypothetical example, 40% of your bad loans end up being bad debt. So what that means is that a company that's lending will have to write down 40% of their loans, meaning that they're only going to receive 60% of the entire loan value. And let's say that these bad loans represent about 20% of loans outstanding. So I think that means 20% times 40% is going to be 8%. So 8% of the entire loan outstanding, so all of the debt within a certain economy is lost. So 8% of the loan value is lost. And then another further problem is that the debt level within an economy is twice the amounts of the income. So that'll say that the value of all of the outstanding loans is twice the GDP. So then we can multiply 2 times 8%, and that'll give us 16%. So this 16% represents the percentage of bad debts relative to the income of an economy. And so that means that 16% of this economy has to I think this means that 16% of the economy is essentially lost. It's either lost or has to be used to service these debts that are being paid. So that's something I have to consider. So what happens in this case when the losses we infer about a nation with bad debts about this metric. Okay. I'm gonna flag this real quick okay, it is flagged. Alright, nice. What is a simple relationship between spending and income? So I think a general idea between spending and income is that one person's spending is another person's income. Whenever you're buying something, let's say at a farmer's market, you're spending money, but whoever you're buying it from, probably a farmer, they're making money off of that. So, one thing I did forget was usually when you buy something, there's probably sales tax involved too. And so a portion of your spending does go to the government. So, how do short-term debt cycles lead to long-term debt cycles? This one's hard. So we previously established the differences between short-term debt cycles and long-term debt cycles. It's the different levels of debt burdens and also the effectiveness of monetary policy. And so I'm thinking that how short-term debt cycles, they might elevate the debt burdens. So that means there's a high level of growth. There's a high growth in in debt versus income. And at some point within the short-term debt cycle, interest rates are already at zero or near zero, and so the effectiveness of lowering interest rates isn't going to help an economy. And so I think at some points, the elevated debt levels that result from short-term debt cycles and interest rates approaching zero or near zero, that ends up leading to long-term debt cycles handled by central banks using its toolkits of interest rates, levers, and money printing. Ray Dalio claims that human nature encourages people to spend more instead of paying back what they owe, thus resulting in higher economic activity and debts after the mini boom and bust. Over long periods, debt rises faster than income. At some point, these short-term debt cycles will lead to an unsustainable level of debts. The central bank will have less and less flexibility with its toolkit. It's like human nature encourages people to spend more instead of paying back what they owe. Okay, I think this is okay. So over long periods, debt rises faster than income. That's usually what contributes to a long-term debt cycle. And short-term debt cycles involve mini booms and recessions. Okay. Excuse me. Alright. How can credit and debt be a good or bad thing? Credit and debt can be a good or bad thing because the availability of credit allows economic development, but too much credits, too much debts can cause a lot of bad debt losses. Credit and debt comes from what is produced and how much can be paid back. This is called debt servicing. Okay. What does debt servicing cost tend to outpace then? When does debt servicing cost tend to outpace then the debt level? Pace the debt level. When does the debt servicing cost tend to fall behind and become lower? Yeah, so I think this is when interest rates are one of the key factors that drive the debt servicing cost. So debt servicing costs are just the cost of paying back your debt. And there's really two costs that are involved here. One is your interest payments, coupon payments, and then your second is going to be your principal. And so principals, those just are really determined by the need for credit by different types of companies, and maybe the economy might be a key factor there. But I think even more important is the interest that is paid on debts, and that really does come down to the target federal funds rate, I believe, in the US, and I guess different rates that are controlled by central banks in other countries. And so usually when you're talking about different types of debts, the interest on those is determined by a base rates and then a spread. The spread usually referring to the risk premium in terms of, let's say, credit risk or default risk, maybe interest rate risk. So the risk premium involved when taking on that debt. Interest rates are really high. 1980s US, the cost of debt servicing outpaced the rise in debt levels due to the high cost of borrowing. When interest rates are really low, plus US cost of it fall behind. Okay. Even though debt crises are well managed, can they still be costly to people? Yeah, they definitely can. So I think, and some of Ray Dalio's examples, some of the debt crises he mentioned were well managed, but they were still really long term and also still super costly to the people within the economies. What are the political implications for debt? So Ray Dalio claims that a lot of politicians think it's easier for policies that favor looser lending standards compared to tight lending standards. And I guess that just goes back to the fact that he claims there's a lot of people that would prefer to spend more than they actually have. So they favor spending, I think, over saving. And I guess that's just human behavior. I'm not a psychologist or anything like that, so I couldn't tell you what the answer is there. Let's see. It's politically easier to allow easier credit, favor loose lending standards over tight lending standards. Okay. What does it mean to write down debt? So writing down debt is just saying that you're agreeing to receive less than what you originally owed. So financial institutions that are lending out to different companies, if the company can pay back the full amounts, then a lender would probably have to write down their debts and agree to receive less in order to receive whatever they can from the company itself. Okay, that's okay. What are the two purposes of money according to Ray Dalio? So he claims that one, it's a medium of exchange. It's a way that people can use money to exchange different things, and also it's a storeholder of wealth. Okay. What is the usual differentiating factor behind mild recessions to harsher depressions? Mild recessions, I think, is going to be... Okay, let me start over here. I think the differentiating factor is going to be the effectiveness of monetary policy. I think that's what Ray Dalio says. Because with mild recessions, usually you see central banks being able to control interest rates. And they also might have control over the currency in which the debt is denominated in. So that means they're able to print more money in order to actually pay off their debts. But I think the biggest factor here is going to be the actual rate of interest. So if you're in a recession, mild recession, usually you have the ability to lower interest rates. Harsher depressions, you're at near zero rates, and that won't really help at all. Okay. So the economy, this usually leads to increasing the amount of debt in the economy as a byproduct of easy to access debt. In harsher depressions, central banks usually do not have the ability to pull this lever because interest rates are already near zero. Deleveraging, okay. I'm gonna sync this up. Oh wow. Okay, I think this actually synced up with the time I did it on the plane. So, yeah, that's interesting. Okay, I think I'll just go through one more, and then I'll get started on the readings for today. So I think let's do one more. What is a simple explanation to why lending has a self-reinforcing upward movement, and what happens at the top of the cycle? When we think about lending having a self-reinforcing upward movement, it has to do with the fact that when you're lending, what you're doing is you're providing people with money that they might not have through credit. And so whatever, I guess the debtors, they'll use this money to hopefully create some productive or economically valuable projects that will elevate their income and also elevate the incomes of other people. And so this will impact growth in asset prices and also just income. And the growth in asset prices and income will then stimulate further lending. And so this growth in income and asset prices will then stimulate more lending, which will then stimulate more growth, which will then stimulate more lending. And usually at the top of the cycle, this is the phase that happens before a recession or deleveraging or a depression begins. And so at this case, I think the rates of lending tends to outpace the growth in actual income in spending, I believe. So I think what that means is you have greater debt outstanding than the spending done by consumers, and also income generated by an economy, so GDP. Spending and income above. Okay, never mind. So I think this. Eventually, the borrowing, spending, and income, with spending and income above the consistent growth of the economy, and more lending is done based on the expectation that this growth will continue forever. Yeah, I think that's different from what I'm saying here. So this is saying that
I know.
the growth in spending and income of the economy, that the growth will continue forever. So I guess maybe there is a greater growth rates than the long-term average of the economy, but usually that isn't sustainable. So I guess that is kind of this mean reversion where long-term growth, I guess higher growth will probably revert back to the long-term average. I think that's what this is trying to say more so than what I was talking about. I think I said something along the lines of the loans outstanding, the growth in loans outstanding is more than the actual spending, consumer spending, and income of a government. Yeah, I guess that's something different. So I'm gonna mark this as hard. All right, and then also probably get started on the actual chapters now. Oh, okay. I'm going to create a new deck called Inflationary Depressions. And then add that to part 1. Okay. So let me see before I get started. If I need to. Okay, I just got a notification too that there's another budget meeting for the U.S. It seems like they approved another 1.7 trillion or so, something like trillions. I don't know the exact number, and debt to fund the government again. So, and developments and arguments about that. So it'll be interesting to see if one day the U.S. economy just goes kaput. Alright, let's get started on this thing, yeah? Let's see, how long have I been streaming for? 40 minutes. Alright, I'm probably going to read for another 15 and then head over to the business school. Gotta go use the bathroom. And it's kind of cold outside, so it's not great either. positive self-reinforcing cycle is. Okay, so let me. Oh, I've barely been updating this. Start reading. Okay. Nice. Nice.
So I'm not sure this is a unique issue per se. This is a situation that like asking folks to be part of your guys' talk this time. I've been a grad student here for a while. Kind of failed to find an advisor and started struggling with my TA work and my grades and courses. Came back around 9 months ago. And an advisor came in thereafter. And we've been moving forward with advanced advocacy. Partly because there's a certain number of quarters you have to like advance advocacy by under your So the deadline was last quarter, and I went to my like oral exam. And so I walked out of that and like met with my advisor and I asked the department secretary and they're like, it's fixable for you can hire you as a TA this semester, but you made the like tuition fee that's out, you just try again and at the same time, I'm still not doing great for TA. I was waiting slowly, and I was really on the defense department, so I was TA in a history of science course, and so I was like, so I came back, and a week into this semester, and signed up for courses, should have presentations, so I was doing that, and the department secretary sent an email to the office. So I come in on Tuesday, and my advisor meets with me, and the data secretary meets with me, and they're like, yeah, the department's decided to submit a request for this qualification. And this was the first time I heard that. It was a shock. And I don't know under what circumstances, like, sort of be appealed or modified or whatnot, but that seems like the sort of thing that you
So are you working or you know, so you were not. So I'm not super familiar with the process about because most of the academic matters are pretty separate from but is it like your drive like is
it seems like it's hard.
Self-reinforcing cycle. Okay. Nice returns.
So
Okay. I think I'm gonna walk over to business school and then gotta use the bathroom right now. After that, probably
I've not met with the
continue reading through
chair.
this chapter, although it touches just some topics that I'm not really familiar with, especially the world of currencies. I have no idea how currencies are affected by monetary policy and also how they affect asset prices. So I'm gonna have to do a little bit of research maybe and really focus in on this. So yeah, I'm gonna do that. See you for now, and then I'll resume in 10:15.